Ever wondered what's the difference between stock trading and investing? Well, you're about to find out, so buckle up. We're going for a ride into the world of stocks. Picture this, stock trading is like a sprint, while investing is more like a marathon. Stock trading is all about the short game. It's the practice of buying and selling stocks within a short time frame. Think days, weeks, even minutes. The primary goal here is to make quick profits. Traders are like surfers, riding the waves of the stock market, trying to catch the right wave at the right time to make a profit. They rely on technical analysis, chart patterns, and market trends to make their decisions. Now let's flip the coin and look at investing. Investing is the long game. It's about buying and holding stocks for several years, even decades. Investors are like gardeners, planting seeds today, watering and nurturing them over the years to reap the fruits in the future. They benefit from dividends, which are a portion of a company's earnings distributed to shareholders, and capital gains, which is the increase in the stock's price over time. Investors make their decisions based on fundamental analysis. They look at the company's financial health, its competitive position in the industry, its future prospects, and other factors. They're not particularly bothered by the short-term fluctuations in the stock price. Instead, they're more interested in the company's long-term performance. So, in a nutshell, while both trading and investing involve buying and selling of stocks, they're not the same. It's like comparing apples and oranges. The time frames and the strategies used are what make trading and investing different. While both practices involve buying and selling stocks, the time frames and the strategies used are what make trading and investing different. Now, let's delve deeper into the world of stock trading. First up, we have day traders. These are the sprinters of the stock market, making multiple trades within a single day. They're looking to capitalize on small price movements in highly liquid stocks. It's a high-speed, high-risk, high-reward game where a single day can bring big wins or significant losses. Next, we have swing traders. Think of them as marathon runners, keeping a steadier pace. They're in it for a bit longer, holding positions for a few days or even weeks. They attempt to capture gains in a stock within a few days to several weeks. Their trades are usually based on technical analysis and price patterns. And then there are position traders. These folks are the ultra-marathoners of the stock market. They're not bothered by short-term market fluctuations. Instead, they hold positions for months or even years, patiently waiting for their chosen stocks to reach their value potential. Unlike day and swing traders, position traders are often more reliant on fundamental analysis over technical charts. Each type of trader operates on a different timeline and makes different types of decisions based on their strategies. A day trader, for example, will need to stay on top of the market minute by minute, whereas a position trader might only check their portfolio a few times a month. The type of trading also varies with the different order options available. For instance, you have market orders that are executed at the current market price, limit orders that are executed at a specified price or better, stop orders that become a market order once a certain price is reached, and many more. Each order type offers different levels of control over how the trade is executed. But remember, there's no one-size-fits-all strategy here. The type of trading you choose depends on your risk tolerance, time commitment, and financial goals. It's all about finding what works best for you and your financial journey. On the other side of the coin, we have stock investing. While trading can be a fast-paced whirlwind of buying and selling, investing is a more long-term commitment. It's like planting a seed and patiently waiting for it to grow into a mighty tree. When you invest, you're buying stocks with the intention of holding onto them for several years, maybe even decades. To do this, you typically look for companies that you believe have a bright future ahead. Companies that are innovators, industry leaders, or have a competitive edge. It's about understanding the business, its financials, and its potential for growth. Why might someone choose to invest rather than trade? Well, there are some unique benefits to this approach. Firstly, investing gives you the potential to benefit from compound interest. This is when the interest you earn on your investments begins to earn interest itself. It's like a snowball rolling down a hill, growing larger and larger. The longer you leave your money invested, the bigger this snowball can become. Secondly, investing can help you weather market downturns. When you're investing for the long term, you don't need to panic every time the market takes a dip. Instead, you can stay calm, knowing that markets have always recovered from downturns in the past. Lastly, investing is less time-consuming than trading. Once you've done your initial research and bought your stocks, you can sit back and let your money work for you. You don't need to constantly monitor the markets or make quick decisions, but remember, investing isn't without its risks. The value of your investments can go down as well as up, and you could lose money. But by diversifying your portfolio and investing for the long term, you can spread these risks and increase your chances of success. Investing is a marathon, not a sprint. It's about building wealth over time. So if you're someone who likes to think ahead and you're not afraid of a little patience, stock investing could be just the ticket for you. So how do trading and investing really differ from each other? Let's break it down. The first key difference lies in the time frame. Trading is often short-term, with traders buying and selling stocks within days, hours, or even minutes. They aim to profit from short-term market fluctuations. On the other hand, investing is a long-term game. Investors buy stocks and hold on to them for months or even years, hoping to profit from the company's growth over time. Next, let's talk about risk and return. Trading can potentially yield high returns in a short time frame, but it also carries a high level of risk. It's not uncommon for traders to experience significant losses. Investing, however, is generally considered less risky. While the returns may be lower in the short term, the long-term growth potential of a solid investment can result in substantial gains over time. Now, on to research. Traders need to constantly monitor the market and make quick decisions based on price movements and trends. This requires a significant amount of time and a deep understanding of technical analysis. Investors, alternatively, focus more on a company's fundamentals, such as its financial health and market position. They often spend a great deal of time researching before making an investment, but once they've invested, they can typically sit back and let their money work for them. Lastly, let's discuss the market philosophy. Traders operate on the principle of timing the market. They aim to buy low and sell high, exploiting small price gaps for profit. Investors, however, believe in time in the market. They invest with a long-term perspective, understanding that despite short-term market volatility, the value of good companies will increase over time. Whether you choose to be a trader or an investor, remember that both require knowledge, discipline, and a clear understanding of your financial goals. Therefore, it's crucial to educate yourself, develop a solid strategy, and stay committed to your financial journey.